Most traders drown in noise. They stare at 1-minute charts like slot machines, chasing every flicker, every shadow, every tiny green pixel that appears on their screen. They treat trading like a video game where more clicks equals more points. Then, they wonder why their accounts bleed out in 3 months. Here's the brutal truth nobody wants to hear. You're not trading price. You're trading static. You're trying to read a novel by staring at ink molecules instead of reading the sentences on the page. Let me tell you about Marcus. 6 months into trading, he was down 42%. Not because he was stupid, engineering degree, sharp mind, methodical approach to problems, but his trading setup looked like the cockpit of a fighter jet. 4 monitors, 12 charts, news feeds scrolling, Discord channels pinging notifications every 30 seconds. His day started at market open, and he'd sit glued to those screens for 8 straight hours. He'd enter on a 5-minute breakout, panic out on a 15-minute pullback, then re-enter on a 3-minute reversal pattern. Some days he took 15 trades before lunch. He was busy. He felt incredibly productive. He told himself he was gaining experience, learning the market's rhythm. What he was actually doing was bleeding his capital one impulsive decision at a time. His wife asked him once why he looked so exhausted working from home. He couldn't explain that watching price tick by tick for 40 hours a week was more draining than any physical labor he'd ever done. Every loss felt small in isolation. $50 here, $80 there, $120 on a bad stop-out. But they compounded into something devastating. The amateur mistakes activity for progress. Marcus thought he was a trader. In reality, he was just donating liquidity to professionals who were patiently waiting on the sidelines. Then his mentor forced him to delete every time frame except one, the 1-hour chart. No tick data. No 5-minute dopamine hits. No second guessing. The rule was brutal in its simplicity. You cannot touch the mouse until the hourly candle closes. Just wait for the hour to finish, and read what it says. Marcus thought his mentor was insane. He said, "But I'll miss moves." And that revealed the second brutal truth. The fear of missing out is exactly what makes you miss the money. For the first week, Marcus went through withdrawal. Literal withdrawal, like an addict cut off from his drug. He'd watch price move and his hand would twitch toward the mouse. He felt blind. He felt like he was missing the action. But he sat on his hands and waited. By week 4, something shifted. He started noticing patterns he'd never seen before. He began pointing out where buyers had obviously failed inside a single 1-hour candle. He noticed where sellers pushed price down only to be completely rejected by the close. By week 8, after cutting his trade count by more than 70%, Marcus was profitable again. Same market, same instruments, same person, different lens. Why? Because the 1-hour candle filters out the lies. Picture this scenario in real time. Years/USD opens at 1.2 thousand at exactly 10 ULO-AM. By 10:15, it rips upward to 1.2 I-60. On the lower time frames, this looks like the start of a massive breakout. Social media screams buy. The 5-minute traders are piling in, leveraging up, buying the highs because they see that giant green bar forming. But the hour isn't over. By 10:45, the buying dries up. Smart money that sold into that liquidity starts pushing back. By 10:55, price is falling. When the clock strikes 11 ULO-AM, the candle closes at 1.2010, leaving a long upper wick. The amateur looks at this and sees green. Still bullish. They hold their losing position, hoping it comes back. The professional looks at that exact same candle and sees a crime scene. They see 60 minutes of intense effort by buyers to push price up 60 pips, and they see that effort fail. They see 50 pips of ground taken and immediately surrendered. That upper wick isn't decoration. It's a graveyard of trapped longs who bought between 1.2020 and 1.2060. Same candle. The amateur sees opportunity. The professional sees risk. This is the first psychological shift Marcus made. He stopped judging candles by color and started judging them by where they closed relative to their extremes. A green candle that closes near its low isn't strength. It's exhaustion. A red candle with a long lower wick at support isn't weakness. It's absorption. The 1-hour candle compresses 60 minutes of fear and greed into one readable story. Every wick is an attempt. Every body is a compromise. Every close is a verdict. Livermore called it the tape on a higher vantage point. You're not reacting to every tick anymore. You're reading the campaign. Marcus spent his first month just watching. No trades, no entries. His mentor told him, "You're learning to read before you learn to write." He'd mark every candle that showed rejection. He'd note when price closed near extremes versus the middle. He'd track what happened in the next few candles after specific patterns. Slowly, he started seeing the language. The market wasn't random. It was readable, not predictable, but readable. But here's what separates the tourist from the operator. Most traders never learn to read candle structure. They see red and panic. They see green and chase. They don't understand that every hourly candle carries a message about trapped traders, about exhaustion, about failed attempts. In the next 4 chapters, you'll learn exactly how professionals decode that message. You'll discover why the close matters more than the color. You'll see how to spot trapped traders inside a single bar. And you'll understand the one discipline that turns gamblers into compounders. We'll return to one mystery, why one specific type of 1-hour candle at a pivotal point can predict a major move before it happens. You've probably seen it 100 times. You just didn't know what you were looking at. The 1-hour candle never lies. You just have to learn its language. Most traders obsess over how a candle looks while it's forming. They get hypnotized by the pulsing green line, the sudden drops, the erratic jumps that happen 20 minutes into the hour. They treat each tick like a vote in some democratic process where the loudest voice wins. Professionals obsess over something completely different. They obsess over where a candle finishes. You have to understand that an open candle is nothing more than an opinion. It's a debate in progress. It's like watching a court case where lawyers are screaming, presenting wild evidence, making emotional appeals. That's the wick. That's the volatility during the hour. But the only thing that goes into the history books, the only thing that actually changes anything, is the verdict delivered at the end. Here's the first and most important rule of reading 1-hour price action, and if you write nothing else down, write this. The close is the verdict. The wick is the argument. The market can argue for 59 minutes and 59 seconds. It delivers its verdict in the final second, when that candle locks into place forever. Let me break this down with real scenarios so you can see the massive difference between how an amateur sees the market and how a professional reads the tape. Picture this. USD opens at 1.2 thousand at exactly $9 a.m. on a Tuesday morning. Volume is high. Momentum is building. 15 minutes into the hour, price rips upward aggressively. It surges to 1.260. On your screen, this looks like a rocket ship. The 5-minute chart is painting massive green bars. Twitter erupts. Discord channels ping notifications. Everyone's screaming breakout confirmed. The amateur trader sees this expanding green bar and panics about missing the move. Their brain floods with FOMO. They buy at 1.2050, convinced they're catching the wave early, terrified the train is leaving without them. But the hour isn't over. The market has presented its argument for higher prices, but it hasn't delivered a verdict. Over the next 45 minutes, something quiet happens that most people never notice. The buying pressure fades. No fresh buyers step in at these elevated levels. The professionals who sold into that surge start pushing back. Large commercial players see 1.2060 not as a breakout, but as a premium price to unload inventory. They start selling methodically. Price begins to drift lower. 1.2050 becomes 1.2040, then 1.2030. By 9:55, it's at 1.20. When the clock strikes 10 a.m. and the candle officially closes, it prints at 1.2010, leaving a long upper wick stretching from the close all the way up to that 1.2060 high. The amateur looks at this finished candle and says, "Well, it's still green. It closed higher than it opened." The bulls are still in charge. They hold their losing position, or worse, they add to it. The professional looks at that exact same candle and sees a crime scene. They see 60 full minutes of concentrated buying effort. They see bulls pushing with everything they had, using massive amounts of capital to drive price up 60 pips, and they see that entire effort fail. 50 pips of hard-won ground immediately surrendered. That upper wick isn't just a line on the chart. It's a graveyard of late longs who bought between 1.2020 and 1.2060, now sitting underwater, hoping for rescue that may never come. Now flip the scenario entirely. Same pair, same time frame, but this time, panic hits. Price dumps from 1.2000 down to 1.1940 within the first half hour. It's violent, ugly selling. News feeds flash bearish headlines. The lower time frames look apocalyptic with red candles stacking on top of each other. The amateur sees this speed and violence and thinks the market is crashing. They short right at the lows, convinced it's going to zero, chasing the momentum down. But in the final 10 minutes of the hour, something shifts. The selling pressure dries up completely. Smart money steps in quietly, absorbing all that panic. They buy passively, soaking up every market sell order that hits the book. Price snaps back like a compressed spring and closes at 1.1990, leaving a long lower wick from the close down to that 1.1940 low. The amateur sees the red color and says, "Red candle. Bearish trend continues. I'm adding to my short." They enter more short positions right at the close. The professional sees that same candle and thinks, sellers just fired their biggest weapon. They pushed price down 60 pips with maximum force and couldn't keep it there. Price was completely rejected at the lows. Someone with deep pockets absorbed all that selling and pushed it back up. Same colors, completely different stories. The 1 hour close shows you where the real power stayed after all the noise settled. This is why professionals seem so patient. It's not that they don't feel greed or fear. It's that they force those emotions to wait until the candle is finished. They have rules that treat waiting for the close as part of their trading edge, not a burden. Here's your protocol, and this is not optional if you want to survive. Step 1. Wait for the 1 hour candle to close. No anticipatory heroics. No entering at minute 55, because you're pretty sure where it will close. The close is sacred. Trading before the close is gambling on a verdict that hasn't been delivered yet. Step 2. Compare the close to the extremes. This is your structural analysis. Did the candle close near its high? That's genuine strength. Buyers controlled the entire hour and finished strong. Did it close near its low? That's authentic weakness. Sellers dominated and finished in control. Did it close in the middle with wicks on both sides? That's indecision. Nobody won the hour. Step 3. Ask yourself this critical question every single time. Who is now in pain if price moves against this close? Because pain creates future moves. Trap traders don't sit quietly in losing positions. They panic. They exit. Their forced liquidations become your opportunity. When you start applying this religiously, your brain will rewire itself. You'll stop asking, is this candle big or small, green or red, and start asking, who just got exposed here? Who thought they were safe 30 minutes ago and now feels trapped? That shift from color to control, from appearance to structure, is the beginning of professional thinking. Let me tell you about David. He'd been trading for 2 years, barely break even. His journal was a graveyard of almost trades. He kept buying breakouts that failed and shorting breakdowns that reversed. Sound familiar? Then he started applying this one rule: only trade after the 1 hour close, and only when the close tells a clear story about trapped participants. His first winning streak came from doing nothing but shorting failed bullish candles. He'd wait for a strong green candle to close near its low, indicating buyer exhaustion. Then he'd short the next candle with a tight stop above the wick. His win rate barely changed, still around 55%. But his average winner became twice his average loser because he was trading with forced liquidations, not against them. He wasn't predicting the future. He was positioning himself to profit when trapped traders were forced to exit their pain. You'll notice something profound and counterintuitive when you start doing this. Some of the best-looking candles are actually exhaustion signals. Picture a massive green candle that shoots up 80 pips. Looks incredible on the surface. But when you check where it closed near its low. That means buyers pushed hard made initial progress, but couldn't sustain the effort. They're tired. That's not strength wearing a bullish mask. That's exhaustion. On the flip side, some of the ugliest, messiest candles hide quiet accumulation. A small red candle with a tiny body and a long lower wick at a major support level. It looks bearish. But what actually happened? Sellers pushed hard, hit that support level, and got completely rejected. Smart money absorbed all that selling pressure without making any noise about it. The professional doesn't chase the candle that looks good on the surface. They stalk the candle that traps someone. They're hunting for the wick that proves a specific group of traders is wrong and exposed. Because here's the truth that separates amateurs from professionals. You don't get paid for being right about market direction. You get paid when other people are forced to exit because they were wrong. Trap traders are the fuel for every significant price move. They provide the liquidity you need to enter and the momentum you need to profit. In the next chapter, we're going to dive directly into that engine. How to spot trap traders on the 1-hour chart, and how to trade against their fear instead of participating in it. Because once you see where the real fuel for the next move is hiding, trading stops feeling like gambling and starts feeling like reading a script that's already been written. Every big move you admire on the chart, every explosive rally that makes you wish you'd caught it, every cascading sell-off that looks like free money in hindsight, was paid for by someone else's pain. That is an uncomfortable truth, but you cannot trade successfully until you make peace with it. The market is not a cooperative environment where everyone wins. It's a zero-sum battlefield where liquidity flows from the impatient to the patient, from the emotional to the disciplined, from the trapped to the prepared. Professionals know this in their bones. They understand that price doesn't move far because everyone suddenly agrees on direction. It moves far because one side gets cornered with no escape route except to surrender their position at the worst possible moment. Amateurs pretend it's random. They tell themselves stories about algorithms, manipulation, or mysterious forces beyond their control. Anything except the brutal truth that someone was wrong, and they were forced to pay for being wrong. Here's the second major rule of reading 1-hour price action, and this one will fundamentally change how you see every chart. Find the trapped side. Trade with the other. Until you internalize that concept, you'll always be providing liquidity to smarter money instead of taking it from desperate money. Let me show you exactly how this works with a scenario that plays out hundreds of times every day across every liquid market. Picture your USD grinding sideways for 3 full days in a tight, boring 50 pip range. There's a clear ceiling at 1.2000 that has rejected price 4 separate times. There's an obvious floor at 1.1950 that is held through multiple tests. It's choppy, frustrating action. Scalpers are getting whipsawed. Breakout traders are losing money on false signals. The only winners are market makers, collecting spread on both sides. You're watching this range, marking those levels on your chart. That 1.2000 resistance has become sacred. Every time bulls try to push through, they get smacked back down with authority. Every trader watching this pair knows exactly where the line in the sand is drawn. Then on day 4, something changes. You get a strong, aggressive 1-hour breakout candle that rips through that 1.2000 ceiling with conviction. This isn't a marginal break that barely squeaks above resistance. Price opens at 1.1990, builds momentum throughout the hour, and closes decisively at 1.2025. That's 25 pips above a level that held for 3 days. Volume spikes noticeably. The candle body is clean, strong, and impressive. Social media erupts. Range breakout confirmed. Screenshots flood Twitter with arrows pointing up. Discord channels light up with rocket emojis. The amateur trading community, starved for a clear directional move after days of chop, feels a rush of relief mixed with greed. They pile in long right at the close or on the next candle's open. They have no written risk plan. They aren't considering what happens if they're wrong. Their stops, if they exist at all, are afterthoughts. They're thinking, finally, this boring consolidation is over. We're heading straight to 1.2100, maybe 1.2150. I'm not missing this breakout. They buy at 1.2025, 1.2030, some even chase it to 1.2040. They feel safe. The chart told them to buy strength, so they bought strength. The breakout looked textbook perfect. Now watch what happens next. The following hour opens, and instead of extending higher as everyone expects, price starts to feel heavy. It tries to push toward 1.245 in the first 15 minutes, but no fresh buyers step in at these elevated prices. The smart money that sold into that breakout surge starts pushing back methodically. Price begins to drift lower. 1.240 becomes 1.2030, then 1.2020, then 1.2010. By the time that second candle closes, it prints at 1.1985, not just below the breakout close of 1.2025, but decisively back below the breakout level itself and inside the previous range. Stop and absorb what just happened from a psychological perspective. Every single trader who bought that breakout above 1.2000 is now trapped underwater. They entered thinking they were buying strength and confirmation. Instead, they bought the top of a failed move. Their entry was around 1.2025, and price is now at 1.1985. They're down 40 pips, and their confidence is shattered. But here's the critical part. They don't sell immediately. Human nature won't let them. They hold on. They bargain with the market. They tell themselves, it's just a retest. It's just a shakeout before the real move. I'll give it one more candle. They are no longer trading. They are hoping. The professional reads that failed 1 hour breakout and sees something completely different. They don't feel bad about missing the initial move. They don't curse themselves for not being quick enough. They think, perfect. The market just showed me exactly where the bodies are buried. I now have a detailed map of where trap traders are positioned and approximately where their pain will force them to exit. They know those trapped longs have stop losses sitting somewhere logical, probably just below the old range around 1.1940 or 1.1930. They understand that as price continues to decline, the psychological pressure on those trapped traders will become unbearable. And when a long trader finally panics and exits, what do they have to do? They have to sell. Trapped longs become forced sellers. The professional shorts against that failed breakout around 1.1980 or 1.1985. They place a tight stop above the highs of the breakout candle around 1.2050. If price somehow reclaims those highs and holds, their thesis is wrong, and they'll take a controlled loss. But if the trap continues to unfold, they don't need to force anything. They let the trapped longs do the selling for them. This is the trap trader blueprint in its most reliable form, and you need to memorize this 4-step pattern. First, you need a strong 1 hour move through a clear, established level that everyone is watching. It can't be ambiguous or subjective. The level needs to have been tested multiple times and respected. The break needs to be decisive, not marginal. Second, the candle must close beyond that level convincingly, not just touch it or wick through it, but close beyond it. Because that close is what convinces amateur traders that the breakout is legitimate and safe to chase. Third, within the next 1 to 3 candles, price fails to continue and closes back inside the previous range or structure. This is the rejection. This is the trap springing shut on everyone who trusted that initial breakout. Fourth, you now have a roadmap. You know exactly where the trap traders are positioned and approximately where their stops are located. You trade against their inevitable panic, not with their fading hope. Let me tell you about Sarah, because her transformation illustrates this concept perfectly. She'd been trading for 18 months when I first met her, and her account was down 18% over just 2 months. When I reviewed her trading journal, I saw the same destructive pattern repeated dozens of times. She was buying every breakout the moment it happened. Years/USD breaks above resistance, she's buying. Gold breaks out of a triangle, she's in. She was always early, always trusting the initial move, always getting trapped when those breakouts inevitably failed. She'd enter at the breakout level, watch price reverse against her, hold through the pain hoping it would recover, and finally exit near her stop for a significant loss. The few times a breakout actually worked and continued, she'd take profit too early, because she was so traumatized by all the failures. Her risk to reward was completely inverted: small winners, large losers, and a steadily declining account balance. Then she flipped the entire script. I showed her this exact blueprint for spotting failed breakouts instead of chasing successful ones. She stopped trying to be the first one into a move and started asking, where are other traders wrong, and how can I position against their mistakes? She'd wait for the initial breakout candle to form and close, Then she'd watch the next candle or two with patience. Only if price rejected back into the range would she enter in the opposite direction of the failed break. She became a hunter of failed moves instead of a chaser of successful ones. Her win rate barely changed over the next 6 months. It stayed around 60%, only slightly better than random, but everything else transformed dramatically. Her average winner became 3 times the size of her average loser. Her monthly returns went from negative 18% to positive 12%, then positive 21%. Why such a dramatic improvement with roughly the same win rate? Because when you trade with a trap instead of against it, you're riding a wave of panic rather than fighting a wall of hope. Trap traders don't negotiate on price when they're scared. They just want out. Their forced exits create the exact momentum you're positioned to capture. Notice the massive psychological shift this requires. You're no longer trading your own emotions. You're not buying because you feel bullish or selling because you feel bearish. You're trading other people's emotions. You're positioning yourself to profit when fear finally overwhelms hope in trapped participants. You're not hoping for a move based on your analysis or feelings. You're calculating where pain exists in the market and waiting for that pain to be realized through forced liquidations. The amateur asks, will this go up or down? The professional asks, who is trapped here, where are their stops, and how can I position against their inevitable exit? One approach is prediction and hope. The other is observation and exploitation. One makes you the prey, the other makes you the predator. When you short a failed breakout, you're not predicting the future or relying on some indicator that might work. You're exploiting a mathematical certainty. Trap traders will eventually exit their positions. Some will exit immediately when they realize they're wrong. Others will hold through increasing pain until their predetermined stop is finally hit. But they all exit eventually, and when they do, they create the exact price movement you're positioned to capture. This is why the best moves often have that accelerating quality that seems to feed on itself. It's not magic or manipulation. It's cascading fear. Each trap trader that exits adds more selling pressure, which pushes price further down, which triggers more stops, which creates more selling pressure. The move feeds on itself until all the trap participants are flushed out. But here's the critical warning that leads directly into our next chapter. Identifying trap traders is completely useless if you're so oversized that you become the trap trader yourself. You can have perfect entries, flawless reads on market structure, and precise identification of trapped participants, but still blow up your account if your position sizing is reckless. In the next chapter, we'll add the missing piece that separates the professionals from the blown-up accounts, position sizing, and the discipline to wait. Because spotting trap traders means nothing if you're risking so much per trade that one wrong read destroys your psychology and your capital. The best setup in the world becomes worthless if you can't survive the inevitable drawdowns that come with any trading method. Here's the paradox that quietly destroys more traders than market crashes, black swan events, or even choosing the wrong instruments. They finally learn to spot high probability setups. They master reading 1-hour candle structure. They can identify trap traders with surgical precision. And then they blow up their account on position size. The edge is there. The analysis is flawless. But the execution kills everything. You recognize the pattern perfectly. You've identified trapped longs above a key resistance level. You see the failed breakout clear as daylight on your 1-hour chart. You know exactly where the stops are buried. You can predict where the cascading liquidations will begin. You feel that familiar surge of confidence, and you tell yourself, this one is obvious. This is the setup I've been waiting for. I can size up here. So instead of risking your usual 1%, you risk 5% of your account. Maybe even 8%. You justify it with phrases like high conviction trade, an A+ setup. You convince yourself that being conservative on such a clear opportunity is actually irresponsible. Then the market does what it always reserves the right to do. It moves against you first. Price whipsaws in the first hour after your entry. It hunts for liquidity exactly where you knew it would, but it hunts harder than expected. It tags your stop by 10 pips, flushes you out of your oversized position with a painful loss, and then reverses exactly in your original direction. Everything you predicted happens. The trap traders get liquidated. Price cascades down 200 pips over the next 2 days. Your analysis was perfect. Your timing was perfect. Your direction was perfect. But you weren't in the trade to profit from being right. You were right about the structure. You were right about the trapped traders. You were right about the direction. But you were catastrophically wrong about execution. And in trading, being right about everything except position size is mathematically identical to being completely wrong about everything. That's not bad luck. That's not the market hunting your stops specifically. That's not manipulation or algorithms targeting retail traders. That's bad process disguised as confidence, and bad process will destroy you with mathematical certainty. The professional approaches risk with a completely different framework. They think in terms of risk per trade, never in terms of position size or potential profit. This distinction sounds subtle, but it changes everything about how you interact with the market. If your account is $10,000 and you've decided through careful consideration and backtesting that you'll risk 1% per trade, that means you're risking $100 on every single trade. Not $100 as some arbitrary round number that feels comfortable, but $100 as the maximum amount you're willing to lose if your thesis is completely invalidated by market action. Here's where amateurs make the fatal error that destroys their accounts. They think that fixed risk amount means they should buy as many shares or contracts as possible while keeping their potential loss under $100. They start with the position size they want, then try to manipulate their stop placement to fit that desired size within their risk budget. That approach is completely backwards and will eventually bankrupt you. Your stop placement must be determined entirely by market structure, not by your desired position size or profit target. If you're shorting a failed breakout above 1.2 thousand on years/USD, your stop must be placed above the highs of that breakout candle, probably around 1.2135. That placement is not negotiable. That's where your thesis gets invalidated. If price reclaims those highs decisively, the breakout wasn't actually failed, and your entire premise was wrong. So if you're entering short at 1.2 thousand, and your structural stop is at 1.2035, you have 35 pips of risk. With a $10,000 account risking 1%, that's $100 divided by 35 pips. Your position size is dictated entirely by that equation. You cannot fudge the numbers to make your position bigger or more exciting. If a different trade setup has the invalidation level only 15 pips away, you can take a larger position while risking the same $100. If another setup requires a 60 pip stop, your position must be smaller. The stop dictates the size. The size never, under any circumstances, dictates the stop. Here's the rule that will save your trading career more than any technical analysis ever could. Your stop loss must be placed at the level that invalidates your thesis, not at the level that protects your ego or makes your position size feel meaningful. But there's an even more insidious trap that catches traders who think they've mastered position sizing. They set their stops correctly at first, based on proper structure, with mathematically sound position sizing. Then the trade moves against them, and they start negotiating with reality. Price comes within 5 pips of their stop, and they think, maybe I was a little too tight. Maybe I should give it more room to breathe. The overall thesis is still valid, I just need to be more patient. So they drag their stop further away, which immediately destroys their entire risk calculation. That carefully planned $100 risk just became $150 or $200. Their disciplined 1% risk per trade just became 1.5 or 2%. That's not discipline. That's not adapting to new market information. That's hope, wearing a disguise. And hope is the most expensive emotion you can experience in financial markets. The professional sets the stop once, based on structure, before entering the trade, and never touches it except to move it toward break-even to protect profits. If the original stop gets hit, the thesis was wrong. There's no shame in that outcome. There's no emotional attachment to being right. The market provided new information that contradicted the original analysis. Take the predetermined loss, analyze what signals you might have missed, and move on to the next setup with your capital and psychology intact. Now here's the mathematical paradox that most traders never understand until it's too late. The smaller your risk per trade, the more room you have to be wrong, and still compound your account over time. Risk 1% per trade, and you can lose 10 consecutive trades, a devastating losing streak, that would crush most people emotionally and still retain approximately 90% of your capital. Your psychology takes a beating, but you're still in the game. You can still think clearly. You can still wait for the next high-probability setup without desperation clouding your judgment. Risk 5% per trade, and just 3 consecutive losses put you down roughly 15%. Now you're not trading from a position of strength anymore. You're trading from fear. You need a 17% gain just to get back to break even. The psychological pressure becomes unbearable. You start questioning your system during normal drawdowns. You start taking revenge trades to recover quickly. You start seeing setups that aren't really there because you need to make back the losses. Fear kills more accounts than bad entries ever will. Bad entries with proper position sizing are survivable learning experiences that make you better. Good entries with reckless position sizing are account killers waiting to happen. Jesse Livermore understood this principle deeply when he said, "It was never my thinking that made the big money for me. It was always my sitting." Most people interpret this as holding winning trades longer, and that's part of it. But there's a deeper meaning that separates professionals from amateurs. Sitting means having the financial and psychological capital to wait, to sit through choppy markets without forcing trades, to sit on your hands when setups are marginal, to sit in cash when the 1-hour charts aren't providing clear signals, to sit patiently for the next trapped trader scenario instead of creating trades out of boredom or desperation. But you cannot sit if you're broke. You cannot wait if you're desperate. You cannot be patient if you're down 20% and need to make it back immediately. Proper position sizing preserves the capital that gives you the luxury of patience. And patience is the ultimate edge in markets that are designed to transfer money from the impatient to the patient. The amateur thinks position sizing is about maximizing gains on winning trades. The professional knows position sizing is about minimizing damage on losing trades so you can stay in the game long enough for your edge to express itself over hundreds of trades. Your edge isn't any single trade. It's the next 100 trades executed with consistent discipline and proper risk management. In the final chapter, I'll show you the ultimate discipline that separates the top 5% from everyone else. Understanding that waiting is an active position. Because once you've mastered position sizing and stop placement, the final frontier is learning that the best trade is often the one you stare at for hours and decide not to take. That doing nothing is sometimes the highest probability play available to you. The amateur thinks trading is about action, about always having skin in the game, always participating, always doing something productive with their capital. They equate screen time with progress and trade frequency with expertise. They feel guilty sitting in cash while the market is moving. They confuse motion with momentum, activity with achievement. The professional knows something fundamentally different. Trading is about patience. It's about recognizing that most of the time, the highest probability move is to do absolutely nothing. It's about understanding that capital preservation during unclear conditions is just as valuable as capital deployment during obvious setups. Jesse Livermore captured this truth when he said, "It was never my thinking that made the big money for me. It was always my sitting." Most people repeat that quote and miss its deeper meaning. They think sitting means holding winning trades longer. That's part of it. But the real meaning is having the discipline to sit with your hands in your pockets when the market isn't offering you anything clear. Waiting is not inactivity. Waiting is a position. When you're in cash, watching the 1-hour charts without entering trades, you are actively positioned for the next high-probability setup. You're preserving capital. You're maintaining psychological clarity. You're avoiding the death by 1,000 small cuts that destroys most trading accounts. Here's what actually separates the top 5% from everyone else. They don't trade every setup they see. They trade only the best setups. They have standards that most traders would consider absurdly restrictive. They don't enter because a candle looks bullish or bearish. They enter because the candle tells a clear story at a pivotal level, with confirmation from the close, with identifiable trap traders, and with risk to reward that's mathematically compelling. Everything else, they watch. They learn. They wait. Remember Sarah from Chapter 3? Her transformation perfectly illustrates this principle. In her first 2 years, she took approximately 60 trades per month. She was incredibly busy. She felt like a real trader. She had positions running constantly, stops to manage, profits to protect. She was engaged with the market 40 hours a week. Her account was completely flat over those 2 years. Then she made the shift. She started waiting for 1-hour setups that met strict criteria, clear patterns at major levels, obvious trap traders with predictable stops, and proper risk-to-reward ratios of at least 3-to-1. Her trade frequency dropped to 8 per month. That's an 87% reduction in activity. Her win rate stayed exactly the same, around 60%, but her account grew 35% in 6 months. Let me show you the mathematics that explain this transformation, because most traders never run these numbers and it costs them everything. Scenario 1. 60 trades per month at 60% win rate equals 36 winners and 24 losers. When you're taking marginal setups just to stay busy, your average winner might be only 1.2 times your average loser. You make 43.2 units on winners and lose 24 units on losers, netting 19.2 units before commissions. After commissions on 60 trades, you're barely profitable. Scenario 2. 8 trades per month at the same 60% win rate equals 5 winners and 3 losers. But because you're only taking setups with at least 3-to-1 risk-reward, your winners are 3 times your losers. You make 15 units on winners and lose 3 units on losers, netting 12 units. Wait, that's smaller absolute profit, right? Wrong. Because in Scenario 1, you're exposed to random variance 60 times per month. Your psychological capital gets crushed. Commission costs eat your edge. You're constantly in the market, during both clear and unclear conditions. In Scenario 2, you're only deploying capital during the 8 clearest, highest probability setups each month. Your exposure to randomness is minimal. Your psychology stays intact. Commission costs are negligible. You preserve capital during all the choppy periods that destroy most traders. Over time, the compounding effect of Scenario 2 destroys Scenario 1 completely. The best traders are bored most of the time. They're like snipers lying in the grass for 3 days, waiting for one perfect shot. They don't shoot at shadows. They don't shoot to relieve tension. They wait for the target to walk directly into their crosshairs. They sit with their hands in their pockets until the setup is so obvious that not taking the trade would be the actual mistake. But here's the final truth about discipline, and this is what separates the survivors from the casualties. Discipline is not a feeling. You cannot rely on willpower when your emotions are screaming. You cannot trust motivation when fear and greed are hijacking your decision-making. Willpower is a battery that drains throughout the day. Discipline is a protocol. It's a systematic checklist that removes emotion from the equation entirely. Before every single trade, without exception, ask yourself these 5 questions. Is this a clear 1-hour pattern at a pivotal level I marked before price arrived? Or am I improvising? Not a marginal pattern at a random price, but a clear rejection or failed breakout at a level the entire market is watching. Are there trapped traders with predictable stop-loss locations? Can I identify specifically who is wrong, where they're positioned, and where their pain will force them to exit? If you can't answer those questions precisely, you don't have a trade. Is my risk 1% of my account or less, calculated properly, based on structural stop placement? Not 1.5%, because you're feeling confident. 1% maximum. Is my reward to risk ratio at least 3-to-1 based on the next structural level, not wishful thinking? Measure the distance to your stop, then measure the distance to your target. If you're not getting at least 3 times the reward, the setup doesn't qualify. Am I waiting for the 1-hour candle to close, or am I trying to anticipate the verdict before it's delivered? If the candle hasn't closed yet, you don't know what story it's actually telling. If any answer is no, you don't trade. You wait, because waiting is a position, and often it's the most profitable position available. We started this journey with a mystery about one specific type of 1-hour candle that predicts major moves. By now you realize there's no magic pattern. The secret candle is simply any decisive close at a pivotal level that traps a group of traders with nowhere to hide. It predicts moves because trapped traders create the fuel through their forced exits. So here's your complete blueprint. The 1-hour candle filters noise and reveals truth about who controlled the last 60 minutes of battle. The close matters infinitely more than the color, because it's the final verdict after all arguments. Trapped traders fuel every significant move through their panic liquidations. Your stop dictates your size based on structural invalidation, never your ego. And the best trade is often the one you stare at for hours and decide not to take. Cut losses fast when your thesis is invalidated. Size small so you survive inevitable losing streaks. Wait for confirmation instead of anticipating. Own your process completely. That's how amateurs become professionals. That's how small accounts compound into significant capital through years of disciplined execution. If you've learned to read the 1-hour candle, the next lesson on multi-timeframe confirmation will show you how to stack probabilities even higher by aligning hourly structure with daily and 4-hour timeframes. But for now, go back to your charts. Delete the noise. Watch the hourly close. And remember, the candle never lies. You just have to learn its language and have the patience to wait for it to speak clearly.